And welcome to ETF Edge, your go-to place for everything exchange-traded fund. I'm your host, Bob Pisani. Two of the best and brightest in the investing world with us today here. I'm joined by Matt Bartolini. He's the head of SPDR Americas Research. He's over at State Street. And Kevin O'Leary, Shark Tank co-host and O'Shares chairman. Kevin, let me start with you. A lot of people over the weekend, I get these emails. I call them 4 exclamation point emails. People who are baffled and a little bit angry about the rally in the markets. Only, 12% from the S&P highs at a time when we're near depression levels on the economic data. Can you just help square this for us? What's your take? Is the market mistaken and delusional, or is the market properly looking ahead to the idea that things are going to get better? What's the right way for people to look at this?
Bob, I think it's the latter. I think what's assumed in the market's outlook, obviously being a forward mechanism, it tries to figure out at what point earnings will normalize. But, since let's go back to the health aspect first. SARS was over 10 years ago. Science has advanced so much that I'm optimistic even that we'll get some kind of therapeutic, if not inoculation, in the next 24 months, 18 months, because the science is so much better. But what's really remarkable about this cycle, and the reason I think equities are doing
I think we just lost Kevin there, but let me just take this whole thing up with you, Matt. I mean, you're a big watcher here. I wanted to talk about ETF flows recently. We're going to bring Kevin back in a minute and get his final take on this. But what I've been watching here is I think 2 trends are really interesting in what's going on with ETFs, and it may be related to coronavirus. The first thing that we've been seeing is more ETF closures than openings this year. I don't remember when that's ever happened. Some of these are these leverage and inverse ETFs that are closing because of unusual activity that's going on there. But also I notice we're still getting money coming in. There's still overall inflows. Dollar amounts are still positive, but most of the money is still going to those mega cap S&P 500 funds, including your own fund, the S&P Index Fund, the IVV, that we're getting inflows there. AGG, the biggest bond fund that you run as well, iShares bond fund, still getting inflows. What do you make of these flows and the closures? And do you think some of this might be related to the coronavirus and how it's impacted ETF investing?
Yeah, I mean, as far as closures versus launches, I think it's more about openings have slowed. If you're looking to start to launch a product, say sometime mid-February, it was becoming very hard. And then in March, it became nearly impossible given 2 aspects. Seed capital was more difficult to come by given the constraints on balance sheets, both from institutions and banks. Secondarily, mobilizing the team to go and have discussions with investors about a new product during a pandemic is extremely difficult, but also unlikely to yield any results given what we were dealing with. Everyone was working from home. And you're really more concerned about how to actually get through your day than maybe thinking about a new investment strategy. So for a lot of firms, the decision was to postpone. So I'd expect actually a ramp up of launches that are sitting on the shelf that will come out in the second half of the year. Hopefully, as those 2 variables I discussed earlier change as our society begins to reopen and get back to something close to normal. Closures are not a surprise. I mean, if you're planning on closing a poor performing fund before this, the events over the last few months made it extremely easier, and it became just an operational experience. With respect to fund flows, every major asset class category monitored has had inflows in April, which to me is just a sign of steadfast usage of ETFs and the desire by investors to allocate capital across a variety of asset classes so as not to miss out as any gains as the global capital markets rallied.
But is that really what's going on, Matt? I mean, it seems to me like the money flows are going into the biggest cap names, basically S&P 500 funds like yours, IVV, Vanguard Total Stock, still getting big inflows, Triple Q still getting inflows. That's where most of the money is going. If you look at there's like 15 funds that had the vast majority of the inflows. Investors still seem to be. My point is they're still buying in to the idea of indexing as the way to go, and so the bigger ones are getting bigger and bigger, and the smaller ones still aren't really partaking in any bigger part of the pie.
Yeah, I mean the bigger funds, they're more liquid, right? So SPY, our S&P 500 ETF, they have garnered a significant amount of assets during this pandemic as it started in February as investors sought out liquid vehicles to allocate capital. But even in April last month, while some broad beta products did have inflows, I would actually say, I would argue that investors actually being more selective and picking their spots on how to buy back this rally, because we saw $15 billion of inflows into sector ETFs in April, with basically healthcare and tech, so XLV, XLK, those funds having the most flows on record in a given month, because investors were indiscriminately picking out areas of the market that would perform best during a period of a sluggish earnings growth, but also economic growth, where those firms' products and services are likely to be sought after.
Yeah. Speaking of picking your spots, I continue to watch in amazement the gold funds, including yours, the Spider Gold shares. IAU there is the symbol there, as well as GLD, your competitor. The money just keeps going into these funds. What I find interesting is gold for investment purposes. I want to own gold, and I want to have an ETF, keeping it in a vault somewhere. Gold for investment purposes is way up, and yet gold demand for jewelry in India and China is way down. The World Gold Council acknowledged that. So it's kind of strange. You got the doom and gloom crowd out there saying, "Okay, I want to hold gold as a bulwark against uncertain times." But jewelry demand, which is the other really major part of this whole equation, is way down. Can you square that for us too?
Yeah, so our product GLD had significant inflows, as well as its sister fund GLDM, but the broader category had $7 billion of inflows in April. And that's really large. And I think it's worth pointing out that gold ETF AUM as a share of global ETF assets is still well below its peak of 9%. So there's been strong investment demand as a result of a supportive macro environment, given that real interest rates are low, extremely low, and potentially negative based on what variable you're looking at, but also macro risk is high. Now, how do you sort of, correlate that with the demand from jewelry? It has obviously waned. It's unclear whether jewelry demand lost during COVID is lost or simply delayed to the end of 2020. If jewelry weakness persists for the longer term as opposed to a short shock, that may weigh on gold over the long run. However, that's not our base case outlook. The macro forces at play, as discussed earlier, are still supportive for gold. And I think, broadly speaking, look at historically, investment demand has somewhat outweigh jewelry demand as a sort of a driver of price, just given the macro forces at play.
Yeah. And sorry, I mixed that up there. GLD obviously is your fund, and IAU, the other one there. Sorry, I mixed that up there. Kevin, you're back. So let me just go back to you and finish your major point that we started off with. We were asking if people still angry about why the market's up so much. You think that the market is correctly looking ahead to the reopening and do better days ahead. Pick up your thought there.
Well, institutional demand for equities is unprecedented given there's very few choices. The average bogey take a CalPERS, they've already gone public this year saying their bogey 7%. Sovereign funds in Dubai or Riyadh, 6%. So if you think about how you're going to do that, your fixed income option of government bonds from the U.S. used to be something you'd even consider. That's no longer an option at 60 to 70 basis points for a 10-year. That's not really going to be very useful. And so if you could find a company, and certainly there's many now that are yielding 2.5% to 3.5% div yield, large cap, liquid securities, that's a very attractive place to park money for the next 24 months. And you're seeing a tremendous demand for it across the board. It's not the retail investor that's driving this market. It's institutional. I speak to them every day. And they're saying, what other choice do I have if my bogey over the next 12 months is 6%? There is no other choice, Bob. It's that easy.